going to introduce Dave Buckwall, one of our charter members, one of the first people to help start this group. So he knows what he's talking about. That's what I think anyway.
Thank you. Well, this is the last session. It's exciting to introduce Barry, but it's also the last session that we stand between you guys and having a couple cocktails. So it's going to be fun. It's going to be interesting. Barry's going to teach you guys today how you can increase the rate at which you grow your wealth management business and which the rate you grow your life insurance business by really learning how to evaluate life insurance as an asset class based on pricing and performance and fiduciary principles. For many of you in the room I've known for quite a few years. Ed, how long have you been in the group now? 13 years. So I don't think I was the first member, but I was probably in the top 5. So I've been studying with Ed for many, many years. I bought into Ed's vision many, many years ago, matching retirees with competent advisors to help them navigate the complex decumulation phase of their lives and avoid obviously the catastrophic consequences that we all know that have happened to people when they make mistakes during retirement. But I started in the business 29 years ago. I started as a life insurance salesman. So that's how I got into the business. Not exactly my lifelong dream to be a life insurance salesman. I'm sure many of you, that's probably the dreams you had growing up, but it certainly wasn't mine. The first 10 years of my career, I did a lot of cold calling, selling life insurance. And you think doing IRA planning is difficult. Try cold calling to sell life insurance policies. Was not fun early on. But I stuck with it, managed to stick around for a little while, and I think many of you know the story. September 11th, 2001, 9/11, my life changed forever, where I had many, many clients in the North Tower of the World Trade Center and lost a lot of clients. But what happened in those months and years that followed was I saw what life insurance did for families and their kids and their grandkids and how it really changed people's lives. And then I think it became more of my mission to be a life insurance person. It's really my passion because I've seen how it can change people's lives. But the more I've studied under Ed over the years and doing retirement planning and IRA planning, one thing that's also happened over the years, I've become extremely frustrated with the life insurance industry, especially with what's happening today. There's a lot of things going on in the life insurance business today with unethical sales practices, misleading statements by agents, comparing illustrations side by side, where people seem to think that somehow the illustration that looks a little better is probably the best policy. Guys running around with these fancy little brochures, these glossy little brochures, put out their company that talks about their 200-year dividend history, and people think companies with the highest dividends must be the best product. Extremely misleading to the clients, which has led to a lot of the problems that we're having today. And what I really have a problem with, life insurance is like this black box that nobody really understands. It's a complex asset, and that's what it is. It's an asset class. And me, like a lot of other people, wish that life insurance would be treated like the investment world and everything else in the financial services industry, especially the way things are trending today, with fiduciary standards, transparency, fee disclosure. Everything else in the financial services industry is trending that way, except life insurance, which is leading to all of the problems today. There are more class action lawsuits going on in the life insurance industry right now. Every time you turn around, there's another article about it. There are policies lapsing every single day. There are clients that are looking at they've had policies their whole lives. Suddenly they get a wake-up call in retirement that their premiums are going to triple or their policies are going to lapse. And we all know what that means. The life insurance company wins, the families lose. And it's a problem that is growing and growing. But what Barry's going to share with you today is a problem that we can work with our clients and really make a difference by what he's going to teach you today. And what's exciting to me, I believe you can really change people's lives on what you're going to learn today and make quite a bit of money along the way. I have never seen what is going on in the life insurance industry right now. I've been doing it for 29 years. I have never seen what's going on right now. with companies raising rates and not disclosing things. Policies are lapsing. It's never been as bad as it is right now, but that leads to incredible opportunities to add a ton of value to your clients. With a DOL coming, or some version thereof, some fiduciary best interest standard, it's coming. And Barry's going to teach you how to apply life insurance with best interest standards. So I want to introduce Barry Flagg. I met him probably about 10 years ago. He started his career as an analyst in the retirement planning business. Between the formative experience with the retirement plans and his experience later on in the life insurance industry, he saw a need to invent some amazing software, which is almost like Morningstar for the investment world. And that's always been the problem with life insurance. Nobody can really understand what the heck it is. They never really understand what they're paying for. It was this black box, and attorneys and CPAs and advisors, no one really understands what you're actually paying. So he created the Morningstar for life insurance, which is what he calls veralytic research, and I don't want to steal his thunder, but he's a recognized expert in applying prudent investor principles to the selection and management of this extremely complex asset class, life insurance. Perhaps most notably by Bloomberg, and he teaches continuing educations for advisors, CPAs, attorneys, and trustees throughout the country. So I want to introduce Barry. I met him about 10 years ago. He's been a mentor to me, but he's probably taught me more about the life insurance industry and life insurance policies in the last 10 years than I probably learned from anybody in my career over the last 20. So thank you for that. It's a privilege to introduce you. You've changed my life, changed my career. Thank you very much, and thank you for what you do for the industry.
Thank you, David. So with that, that concludes the formal part of the presentation. Any questions? I couldn't agree more with most of everything Dave said. Life insurance is the largest, most neglected asset on clients' balance sheets. Joel talked a lot about technologies, competitive threats from big players who have big budgets to invest in technologies, keeping up the investments you need to make in your business, or as Ed said, get out. What I want to talk to you about is taking what you already know. I mean, you're here talking about IRAs, retirement assets, the process that retirement assets are governed by or managed, are prudent investor principles. So I'm going to talk a fair amount about prudent investor principles, but not because I'm trying to teach you prudent investor principles. I know you already know that. What I want to do is apply prudent investor principles to life insurance in ways that you may not have ever seen or heard before. Hope to give you some new tools when you leave here today. This is something that I am convinced an audience like this is absolutely positively needed to address this largest, most neglected asset on clients' balance sheets. It is in desperate need of management. Groups like this who follow a prudent investor operating system, and I will talk a little bit about the life insurance industry operating system versus prudent investor industry operating system. Groups like this are the most qualified to address the problems that Dave talked about. The life insurance industry operating system will not solve all the problems Dave talked about. That operating system has caused the problem in the first place. So I will I hope to challenge some preconceived notions about life insurance. I may sacrifice some sacred cows, but in the end, I hope to give you some new tools to talk with clients about a new asset that maybe you haven't talked to them about before, or maybe not talked to them about like this before, to get some new business. Maybe use it as a conversation to talk to prospects about make them a client, because there is almost no competition in this space. While Joel talked about lots of competition in the investment management space or the wealth management space, there is almost no competition in this space. So I hope to give you some tools and techniques to take what you already know, but apply it to a new asset or a new line of business And I like to sometimes say, grow your business twice as fast, because you're using what you already know just with a new line of business. So you can talk to the same people you were talking to before and generate another round of revenue by helping them. The thing that when I first entered this business, I entered the business as an analyst in the pension investment advisory business. I grew up in a financial planning family. My dad started in the life insurance business first, got frustrated by many of the things that Dave's frustrated by, many of you are probably frustrated by, that frustrated me. So he built himself a full-service multidisciplinary practice before the word multidisciplinary practice was actually a word. And I grew up in that environment. He wouldn't let me work for him, so I went to go work for the partner in charge of the pension investment advisory practice. However, having grown up in a life insurance family and in this financial planning environment, I was one of the youngest CFPs, in fact, supposedly the youngest CFP in the history of the College of Financial Planning. So I'm a CFP, I understand planning, I understand tax planning. Everybody in this room does some degree of tax planning. And so I go to cocktail parties as a young man in Tampa, Florida, in downtown Tampa, with CPAs, tax attorneys, and trust officers, the part of the professional community. And I'm thinking, well, life insurance has 4 tax preferences unique to life insurance. It is the only asset type that has these 4 things. And so if you're in the planning business and you do any tax planning at all, I thought you'd want to talk about life insurance in your practice. Income tax-free death benefits, I won't go into detail on this. Everybody probably knows what it is. Tax-deferred cash values, non-taxable withdrawals, and non-taxable loans, which get repaid by the tax-free death benefit. So it's effectively a Roth IRA, the tax treatment of a Roth IRA, or the tax treatment of a qualified plan in reverse. And everybody here is here because of the tax treatment of IRAs, Roth IRAs, or qualified plans. So if you got the same leverage but in reverse, why would we be interested in that? Well, we're not interested in that. Planners have not been interested in that because my clicker stopped working. Here we go. Planners have not been interested in that because, and I would say it's really not complicated, it's obfuscated. Because very few people know, very few clients, very few advisors, very few life insurance professionals know what is actually being charged inside the policy. Everybody knows what the premium is, and there's a bunch of lawsuits, that, as Dave mentioned right now, class action lawsuits against carriers, where everybody thought it was the premium was the cost, and they've raised costs, and everybody's up in arms about, well, what do you mean you raised the cost? I paid my premiums all these years, and why is my coverage in danger of lapsing? So few clients, few sophisticated CPAs, tax attorneys, and trust officers, and even very few insurance professionals know what's actually being charged. And if the most sophisticated buyers of a particular product don't know what's being charged, how much do you think some insurance companies are going to charge? As much as they can. So there is a huge swing between good and bad pricing in insurance. Adam Smith would say the invisible hand of the consumer hasn't had the benefit of choosing good and bad prices because they hadn't know what good and bad prices are, and therefore there's great price disparity. Few also know what they're actually getting in performance. They're presented with a proposal. The proposal has a hypothetical rate of return on it, and that is almost never reconciled with what is actually, what the actual performance of invested assets underlying cash values. And some years later, they get an in-force illustration with another hypothetical projection, using another hypothetical rate of return, again not reconciling it with past performance. So it's no wonder to me that life insurance has been among the worst performing asset types relative to client expectations in the 3 to 4 decades that I've been in this business. If you don't know what's being charged and you don't know what you're actually getting in performance, how in the world can you possibly manage it? Which is why the state of the industry that we're in, the state of the policy we're in, which is why the life insurance industry can't fix this. But people who build their businesses around prudent investor principles that include knowing what's being charged and knowing what's actually being received in performance, those are the type of people who are, like people in this room, who are most equipped to address this problem, solve clients' issues, and generate new revenue. So I want to give you a new performance formula. And if there's just a couple of things you take away from this, I would encourage you, write this one down. We're going to talk about some things not to do, but write this one down. The premium or the performance, the cash value of any life insurance policy, of every life insurance policy, will be the sum of whatever the insurance company charges for the insurance. That's the largest expense, as you might imagine, because they collect that to pay claims. They collect that money from the living to pay out death claims to those who have passed. It's the largest expense. Policy expenses, so there are expenses for underwriting, for product development, actuarial, service, marketing, distribution, commissions. Those are the expenses. And whatever is paid into a policy above and beyond cost of insurance charges, which start out low and get higher, and expenses, which typically start out higher and get lower, but whatever's paid in excess of those two things gets put into an account, commonly referred to as a cash value account or a policy account, and that cash value or account value earns some interest. It's either credited with interest like a CD, or it earns some interest like on a mutual fund. So this is the formula I would encourage you to write down. Whenever anybody presents you with an illustration that shows premiums, cash values, and death benefits, and little else more, tell them you want those three things. I want to know what's the cost of insurance charges year by year. I want to know what the expenses are year by year. And I want to know what the actual interest calculations are inside the policy, for reasons we'll come back to. You have a question? No questions? Do you have a question? Did you get overruled by this gentleman over here? Hold on.
Right
I
here,
do
buddy.
like an interactive audience, so please, but we got to wait for a microphone. Can we get a microphone here?
We have one here.
How about right here in the back? Straight back to your left. Your right, other left. There you go, right here. Okay. You mentioned fixed interest,
Yes.
life, variable life. You didn't mention indexed, IUL.
I put that into the fixed category because the cash values of indexed products are actually not invested in an indexed. The cash values are actually invested in the general account of high-grade bonds, predominantly high-grade bonds and government-backed mortgages. Only the interest is used by the index.
Gotcha. Thank you.
Okay?
So I'm assuming that if you do the breakout of charges on a life insurance, right here, breakout of charges, is that a fair assumption? Because it breaks out everything, itemized it out, so you can see exactly what the interest crediting earnings are, cost of insurance, charges, everything. That in your opinion, is that a reasonable way to break out all the charges and look at the cost of the insurance?
I think it is, for anybody who builds a business around prudent investor operating principles, it is not just the right way, it is an essential, it's essential information. And it's information that, by the way, this part doesn't come from us. Every universal life or whole life policy, every universal life policy, IUL, GUL, VUL, regular UL, they all, if you ask for them, they will give you the math behind the hypothetical values. Ask for that math. You will be surprised what you find in some cases. Yes, sir.
Well, you kind of answered it, but I was going to ask about the whole life, because you can get anything on a universal, the COI, but how do you actually get the COI, the correct answer on a whole life? I've never been able to answer a question, what's the true cost on a whole life policy, whether it's a brand new one or in force 10 years later?
So the way whole life is constructed, which I don't know that I have time to get into now, maybe at the end we can come back to whole life. The way it's constructed is the actuaries don't actually calculate what they're going to charge for cost of insurance charges. They calculate the maximum they can charge, and then at the very beginning, and then year by year they calculate how much they're going to refund of those charges. And so because it's kind of an amalgamation, the only way to get that is either on a big enough policy, ask the insurance company to have the actuaries provide it, or that is one of the services my company provides. You will get a breakout of what the total expenses are, including cost of insurance charges on whole life policies.
Well, hold on.
Thank you. Do you make a distinction between stock companies and mutual companies?
We studied that. We have not seen any performance difference inherent in the structure of the company itself as it relates to cost of insurance charges, admin fees, rep fees, premium loads, or performance.
We have a question here.
Yeah, so it's also around trying to get to that number of what is the cost of insurance, because that's a function of the amount at risk.
Yes.
And that also depends on what the investment performance is.
Correct.
So how do you identify what that cost of insurance is? And
Hold that thought. That's a good question to come back to. In addition to which, my presentation is normally only 3 hours long, and we're going to cut into, with this number of questions, we're going to cut into the cocktail hour.
Oh, okay.
Go ahead, one more.
All right. We'll take one more, and then we'll hold them, and you'll
Okay.
be around anyway.
Okay?
I'm back here.
Yep.
We'll take this, or I
One
was
more
gonna say,
question?
Barry, we'll take this, and then we'll move on, and you'll be around afterwards, right?
Yes.
Yeah, okay.
Yes, I was just on the phone the other day trying to get this information from a major carrier. We were trying to break down the exact specifics, and they wouldn't provide it. They said it was proprietary, and that part of the formula that they use included your commissions and so on. I said, that's fine. Just wanted to break it out for my client. They would not provide it at all.
So let's talk afterwards so we don't throw any particular
All
company
right,
under
yeah,
the bus.
let's move on so we can get to the material. Yep.
You should be able to get those pages for every registered product that's still available for sale or that's still being serviced. So anyway, you guys got the message. Get those three things, and get them because beyond the reason that I think it's a good idea, having come from the fiduciary space, it seems to make sense to me. But let's also talk about some guidance, some of which is guidance directly applicable to this audience, some of which is parallel. But let's start with what the insurance industry, the guidance from the insurance industry. So the insurance industry came out with rules in 1993, so that's almost 25 years ago. Came out in 1993 with model regulations, the goals of which were to ensure that illustrations do not mislead and are easy to understand. So 25 years ago, they set out to do this. Anybody in this room think they accomplished that? Neither did they, because in 2015, they updated the rules to say that the illustrations that were then in the marketplace appeared to show the exact same rate of return on two different illustrations, and yet they were using a different rate of return inside the illustration, which to me is not only hard to understand, but terribly misleading. So they came out with this AG 49 in 2015. Every time the National Association of Insurance Commissioners comes out with a new rule, somebody figures out a way around it. And so there are a number of carriers, in fact, the overwhelming majority of carriers have gotten into this illustration beauty contest, seeing how much lipstick they can put on their illustration to make it look better when in fact it may or may not be, which is why you've got to get that formula. You've got to, and don't just ask for the percentage of interest, the assumed interest percentage. Get those pages that actually show the math of here's the dollar amount of interest, because if you actually calculate what that interest amount is, you will be shocked at the answer in some products. So if the insurance industry, without much surprise, doesn't provide good guidance for an audience like this, let's look at the operating or the manual for the operating system of the Prudent Investor, for those in the Prudent Investor business. And again, I'm not going to spend a lot of time on this because I'm confident most everybody in this room knows these things, but I'm going to tie them. I'm going to say them so that we're all on the same page, and then I'm going to tie them back to life insurance. So Prudent Investor Act says that those who are managing retirement assets, IRAs if the DOL rule comes through, or even if it doesn't in whatever other form, if you are holding yourself out as an advisor, you have certain duties that go along with advice, one of which is to exercise reasonable care, skill, and caution. However, the principal marketing tool, the principal due diligence tool that comes out of the life insurance industry are these illustration comparisons. Yet, FINRA, which may or may not have jurisdiction over you here, but certainly is a industry body, issuing authority intended to protect the consumer, says that comparing illustrations is inappropriate because unless you're comparing the things that we talked about in the formula, it is misleading. And some of my former brethren from the insurance industry says, yeah, well, I don't believe in variable products, so FINRA doesn't apply. Well, what about the chief actuarial body of the entire life insurance industry publishes a study decades ago, which has since been ignored, saying that if you're comparing hypotheticals to find out which product is better, that's not just inappropriate, it's fundamentally inappropriate. Right? And most recently, the OCC updated their handbook for unique and hard-to-value assets. So this is the handbook for institutional fiduciaries. This is what regulators use when they go into a big bank or a national bank, but big or small. They go into a bank and they're following the guidance that the OCC publishes for here's how you make sure fiduciaries are doing their job. They say that these policy illustrations are subject to a high degree of fluctuation, and anything that's subject to a high degree of fluctuation is not very reliable. So when I talk to either customers like Dave or this software grew out of my practice, when I would talk to clients or their CPA, tax attorney, and trust officer advisors, I would talk about this guidance so that it's not he said against she said or my opinion against a broker who's proposing some hypothetical illustration comparison. It's the financial services industry, the insurance industry, and the banking industry have all deemed these illustration comparisons as misleading, fundamentally inappropriate, and unreliable. So if you're a fiduciary, and I tell this mostly to my institutional fiduciary customers, so trustees of life insurance trusts, do not have, from a compliance perspective, do not have illustration comparisons in your file. You don't want something in your file that is your decision support that is misleading, fundamentally inappropriate, and unreliable when your standard of care is exercising reasonable care, skill, and caution. You just don't want to have that in your file. If you're an advisor, I would use that, this guidance as a way to differentiate yourself from the insurance industry that has caused the problem in the first place. So let's talk about, if we're not going to use an illustration comparison, what do we use? Well, Prudent Investor Act says that we should look at, back to the formula, expenses. And, we should have exercise judgment in what is reasonable to expect in a rate of return relative to risk. And once we have the information essential to make a prudent decision, with a capital P, a prudent decision, then we exercise reasonable care, skill, and caution in advising our clients. Dave mentioned litigation is on the rise, and I don't mention that to scare anybody in this room. This litigation is mostly against insurance companies, marketing organizations, or brokers who don't follow. In fact, they're all against, all the ones I'm going to mention, are against advisors or insurers that don't follow a prudent investor operating system. Cochrane Key Bank, in fact, Cochrane Key Bank, I've written about it in a couple of publications, one of which I've got a few copies at my table. If you email me, I'm happy to get it to you. To me, this is a poster child case that illustrates the difference between practices and outcomes from the life insurance industry operating system versus the prudent investor industry operating system. And if we have time, we can talk more about that case because it is really instructive. I'll skip through a couple of these. The other one that is really interesting is Natia versus a subsidiary of Goldman Sachs. It's interesting because it's kind of a soap opera That's not the only reason why it's interesting, but it's interesting because it's kind of soap opera. Mr. Naccio was former CEO of Quest, was convicted of, I believe it was insider trading, convicted felon. He was in prison when he sued Goldman Sachs for breach of their duty. The financial advisor testified against him, so he was upset a little. And so it's like my dad used to say about retirement plan assets. You know, an employee is probably not going to think to sue you because you abrogated one of your duties in the retirement plan. They're probably not going to, that's just not going to be where they come from. But they're going to get upset about something else, and then they're going to talk to a plaintiff attorney at the cocktail party, and the plaintiff attorney is going to say, well, do you know that your business, the guy who fires you or the guy who upset you, or gal, they're supposed to do these things, and chances are they're not doing them. So they can go get their pound of flesh for whatever they're upset about, but for breach of duty to advise. And that's exactly what happened in the Naccio case. That's exactly what I think happened in the Naccio case. By the way, I read a monthly column for Investment News. You can either follow me on Investment News, you can follow me on Twitter, which I think is up there. I'm also on LinkedIn. I post all of everything that gets published that I write is posted on LinkedIn. And that article, so you can get that article from a number of places, including a couple of copies at my table. So if we're not going to adopt the operating system of the life insurance industry, and we've got this prudent investor operating system, and I know how to apply it to every other asset on my client's balance sheet, but I've never heard anybody talk to me about how you apply it to life insurance. Well, the Financial Planning Association came to the same conclusion. The Financial Planning Association has worked with FI 360. Any AIFs in the room? Okay, so the Financial Planning, the FI 360 has a framework. Financial Planning Association is active in promoting that, helping their advisors follow prudent investor principles for lots of assets. And they concluded, well, we don't have anything like that for life insurance. So we're an organization that promotes fiduciary standard, and yet we're not supporting our members in the performance of that as it relates to life insurance. So they formed a task force. That task force led to a decision-making framework that looks a lot like the decision-making framework that I'm confident you are familiar with, or I'm confident it looks familiar with the decision-making framework you're familiar with. The task force for the final version was vetted by 17 individuals from virtually every profession who have clients who have life insurance. So this is not the broker's perspective. This is not the lawyer's perspective. This is not the trustee's perspective. This was a duke it out. We're gonna after 2.5 days, we're gonna come to agreement on something that works for all of us. As I said, this should look familiar. It's 6 steps. Does the FI 360 diagram use 5 steps or 6 steps? I know the FP 5 steps. I think you're right. So the FI 360 decision-making framework combines 1 and 2. What is effectively 1 and 2, I believe. Yeah. So I don't have time because you asked too many questions. I don't have time, period, to go into there are 17 dimensions under the 6 steps. I don't have time to do all 17 dimensions, but I'm going to hit on the high points, the ones that you can take back and have conversations with clients about this asset that you may not have talked to them about before, about this asset that is the last largest, most neglected asset on their balance sheet, the asset that's in desperate need of management. I want to give you enough to be able to go back and start having a conversation about it. Sorry. So I spoke at the NAPFA conference last week. NAPFA is our fee-only planners. And one of the questions I naturally got, which is why I like to start in my opening remarks talking about slaughtering sacred cows, one of the questions I got is, well, why isn't a fee-only product always better? Well, there are 10,000 different pricing combinations and permutations for every single product. Different price for every age. Different ×2 for gender. ×3 for 2 or 3 for tobacco use, non-tobacco use, or never tobacco use. ×5 for standard risks, preferred risks, standard plus, super preferred, double backflip preferred, times banding, what the investment business would call volume breakpoints for different face amounts, times different commission discounts. Some products, many products allow for commission discounts. So you go through and you start with all the different rates, ×2, ×3. It's well over 10,000 prices for every single product. Times the number of products in the marketplace, it's millions of different prices. In the same way that no mutual fund company is, I don't think, if I took a survey of this room, I don't think we'd get general agreement that there is one mutual fund company that is the best for every client in every situation. Fair enough? Right? Well, there are thousands of different prices of mutual funds. There are millions of different prices for life insurance products. If there's no such thing as the best mutual fund company for all clients in all situations, it stands to reason there is no way one life insurance company is best. We also talked about cost of insurance charges are the largest expense. They comprise 85% of total costs. And they swing by 80%, almost double. Commissions are at most, and I'm not advocating for or against commissions, I'm just doing the math. Commissions are at most 15% of total costs. So if you've got a line item on your income statement, on your client's life insurance policy income statement, that's 85% of the cost and could be twice as much in some policies as other, would you rather get rid of 15% or would you rather get rid of 80%, right? Of course, the best of both worlds is to find low cost of insurance charges and charge reasonable compensation, because we are still in a for-profit economy. So there are always conflicts of interest. Understand the commissions are certainly a conflict. Fee only, by my example, are conflicts. Understand the conflicts. Talk about them up front. Once roles, responsibilities, and conflicts have been discussed, analyze the situation, but analyze it in a way that more naturally leads to prudent product selection. The life insurance industry has a penchant for marketing flavor of the day products. In the 1980s, Universal Life was the product. 10 years later, it wasn't the product. Then it was Variable Life. 10 years later, it wasn't Variable Life, it was Guaranteed Universal Life. And when I say the product, I mean the industry as a whole was the sales of these products were categorical more than the other products. And in the 2010s, it's indexed Universal Life now. That to me defies logic. I understand the marketing benefits of it, but it defies logic because clients don't change that dramatically every 10 years. So define goals and objectives in a way that more naturally leads to product selection. So let's talk about strategizing product selection. Product selection for life insurance, in my view, should be the same as it is for any other financial asset. What's the risk tolerance of the client? What's the asset allocation that corresponds to that risk tolerance? What's the time horizon? How long do we have to withstand or not withstand volatility? And what's the expected outcome? Get the answers to those 4 questions from clients. That should give you a good basis for then prescribing the rate, which is what the acronym makes, a rate of return to start looking or requesting illustrations. But if you request an illustration from the BGA or IMO that you work with, what are you going to make sure you ask for? Come on. Thank you. Breakout of charges. Thank you. I'm running up against cocktail hour. I would also submit that if you go through this process and you come to a place with a client that you would for every other discussion about assets on their balance sheet, then product type is determined by this conversation, which means in 1980, some of those UL policies shouldn't have been sold. And in the 1990s, some of the VUL shouldn't have been sold. And in fact, in the Cochran case, the case that I told you is so emblematic of the difference between the life insurance industry operating system and the prudent investor industry operating system. The advisor recommended a UL product in the 1980s. Now, a UL product has to invest cash values. They have to, by regulation, invest cash values in high-grade bonds and government-backed mortgages, which is a what kind of investor temperament? Conservative, right? Fixed income conservative. The variable life policy in Cochran that they replaced the universal life policy with, they allocated cash values to 100% equities, including emerging markets and international. What kind of asset allocation is that? Ultra aggressive, right? So did the client really go from conservative to aggressive in a day? Or was he a victim of the life insurance industry operating system and the flavor of the day, pension for flavor of the day products? So that's a chart that provides some guidance for product selection, going through that process. So define roles, responsibilities, and conflicts. Analyze the situation in a way that more naturally leads to product selection. Strategize product selection using the RATE acronym. And then formalize the solutions, not being constrained by compensation models, distribution system, proprietary products, prevailing marketing practices. The life insurance industry now looks a lot to me like the investment businesses in the 1980s. In the 1980s, Morningstar was early in its existence. Only about half the mutual funds were in Morningstar. Half the mutual funds in the market were in Morningstar. There were many more load products than there were no load products. Some products were only available through some distribution systems. I mean, this is the life insurance industry of today. So just understand the constraints. If you're working with somebody who, as I think Joel said, has a business card that says financial advisor, but they've got an insurance company name on their business card, their business card is for an insurance company, chances are they've got some constraints on the universe of products that they're able to help you with if you're working with an outside professional. So just understand the constraints, understand that proprietary products have additional incentives. That doesn't mean that the proprietary products might not be better, but just understand that they have additional incentives, so have that conversation. So define, analyze, strategize, formalize, and then same thing you would do in every other, for every other asset on the client's balance sheets, do a search. Just like doing a search in the 1980s for mutual funds, when, by the way, Morningstar didn't come on a disc, it wasn't online, it was a paper book. Some people remember, I was there. They were blue for mutual funds, right? Blue for mutual funds and red for separate account products, right? And only half of the mutual funds were in the book. So the life insurance industry of today looks a lot like the investment business of back then. So it's not as simple. It's not like you can just go online and search. Somebody was asking me that question earlier at my table. I don't know if they're in. Mika? Meek? Go on. So the Veralytics system supports searching for 5 criteria. This is not all the criteria that applies in every client situation, but it is the 5 criteria that apply in almost every client situation. What's the financial strength and claims paying ability of the company? What's the cost competitiveness? And when I say cost competitiveness, I do not mean the premium. I'm going back to my formula. How competitive are the cost of insurance charges being charged inside the policy? How competitive are the expenses? Thank you. I'm running out of gas. I may need you to come up here in a minute. And with insurance policies, how am I doing on time? Huh? Okay. So with insurance policies, I thought cocktail hour started at 5, so I was rushing. Maybe somebody can get me a drink. I'll slow down. How about a little water? So if I bought a mutual fund, or if I invested in a mutual fund, I usually don't drink water out of a bottle. I feel like I'm already at the bar. If I invest in a mutual fund and the fund company increases the expenses or changes managers, I can get out pretty easily, right? There might be a 12B1, but I mean, I can get out. Might be some tax, but it's not onerous. With a life insurance policy, there could be a high surrender charge during the first 10 years. Some products are now 15 years. Some of them are 20 and 25 years. So making sure that the price that we're told up front is based on actual mortality improvements instead of mortality gains, assumed mortality improvements, actual operating expenses instead of assumed operating gains, actual investment experience instead of some hypothetical, is important in life insurance. So we measure against the universe of peer group alternatives, the financial strength of a carrier against its universe, against its peer group, the competitiveness of costs against its peer book, the stability of those pricing representations, the accessibility or restrictions on cash value. All other things being equal, if I have two products that are identical in every way, which by the way never happens, but if they're identical in every way, except one has no restrictions on my ability to get out, and the other one has severe restrictions on my ability to get out, which one do I want? The one you can get out of, right? Because we live in an ever-changing world, particularly with our president, and we may need to get out. Options, optionality. And then the one that is most inexplicable to me is, I alluded to it before, illustrations project some hypothetical rate of return, very often not correlated with actual historical performance of invested assets and underlying cash values. Remembering that I started my career in the investment business, and it was common. I would think that most everybody in this room has this experience. When a client comes and say, I want to start a UGMA account for a grandchild, you say, well, here's the fund that I would put them in. They ask a couple of questions, one of which is, has the performance been any good? I mean, that's a pretty common question, right? And yet, even for small accounts, and yet those same clients put tens of thousands or hundreds of thousands, or over time, or if they're a high net worth individual, even millions of dollars into a life insurance policy and never ask, what's the actual historical performance been? So these are the 5 things that we think are important to ask every time. These are the 5 things that we have in our database and that we publish research reports on so that you can approach life insurance the way you approach every other asset on the client's balance sheets. I'm going to talk a little bit about costs. So this is an excerpt from an actual report to show you how, at a minimum, and so this is not a commercial, at a minimum, get the detailed expense pages they're commonly referred to, the cost breakout pages, get those from the carrier. At least then you're looking at reliable data. Cost of insurance charges, they do change. Someone mentioned net amount at risk. They do change with the net amount at risk, which is something that needs to be factored into the equation. But the rates themselves are pretty stable. The insurance companies have to go to 50 plus different departments of insurance to get an approval for a rate increase. So they're pretty stable. Many life insurance companies have a track record of never increasing cost of insurance charges. A few, have a record of actually decreasing cost of insurance charges over time. So looking at the costs is the first starting point, but knowing that you're being charged $10,000 in a given situation is of some utility, but not as much utility as how does that compare to everything else that's in the marketplace? Because that's what we do with every other asset on the client's balance sheet, right? So in a matter of time, less than I've already talked, we can look at what's the average cost in every client situation. We can know what the average cost is for a given product, because when you have a database, you can calculate an average. It's just math. You can also calculate a standard deviation. So we also know what's the worst price in the marketplace for this client's age, gender, tobacco use, risk class, policy face amount size. How competitive is it among worst available rates and terms? Or is it among best available rates and terms? So if this was one of your clients and they had an in-force policy, you would be able to comfort them in knowing that they made a prudent decision, at least as it relates to cost, and you can move on. If this was a policy, let's say you had a policy where, I don't know if I can do this. I can't reach that. Let's say you had a policy where the bar on the far right was higher than the middle bar. That would be an expensive policy, right? There, you would use this report to go in and say, okay, we subscribe to this independent research. This research indicated that you were being charged excessively. If you're still in the same health risk class, you were being charged excessively in the policy that you have. And so let me show you what a competitive policy looks like. And then you can look at the difference between those two. You can calculate the cost savings. I wrote an article, one of my articles in my monthly column for Investment News is the new marketing tools are a flashlight, a ruler, and a bag. You carry around a flashlight to shine a light on the costs. You get those detailed expense pages, right? You shine a light on the costs. Get a Veralytic report, which is the ruler. Measure the costs. Measure if they're being overcharged. If they're being overcharged, use Veralytic to find a product offering best available rates and terms. Take the difference in those costs, put them in a bag of money, give the client the bag of money and say, this is yours. Tell me how you want to spend it. Do you want more death benefit? Do you want lower premiums? Do you want less risk in your portfolio if it's a VUL policy? Do you want extended coverage duration? Because a lot of policies, the New York Times and the Wall Street Journal have been writing about this, a lot of in-force policies mature at age 100, causing a taxable event. So you got $1 million policy. If they die at age 99, it's $1 million tax-free to their heirs. If they live to age 100, the insurance company sends a 1099 for $1 million less their basis to the IRS. Right? So you can solve that. If you find cost savings, you can solve that problem too. Yes, sir, you had a question. I need a mic. Do we have a mic? Kira's coming.
And we run till 5:30, so we might have time for a few more questions too.
Go ahead, Rob.
Thank you. When you ask for the cost of insurance, companies have minimum and maximums, and they have so much flexibility that they can raise the cost of insurance, and you have nothing you can say about that. And I have seen some carriers lately that have increased the cost of insurance, based on their profitability. And I think you know some of those companies. I don't know if we could talk about those, but how do you handle that?
So there's no guarantee. But I would suggest you handle it the same way you handle every other asset, right? You have a mutual fund. Past performance is no guarantee of future results, but it's one of the things we can use to use our judgment. Right? And I'm not saying that just because they have got good past performance in the past, they're going to have good performance in the performance or their management. So it's a process. If the cost of insurance charges are not guaranteed, some are, and there's actually two different types of guarantees, which I'll come back to. If the cost of insurance charges aren't guaranteed, the way I would answer that question is look at that carrier's stability of their pricing representations. Have they increased COIs in the past? Just because they haven't doesn't mean they won't. But if they've got a track record of actually decreasing cost of insurance charges, then I got even a little more comfort. That's how I would do it. The difference between guarantees, there are products, all products have guarantees. And then there's a category of products that are designed for guarantees, which are guaranteed universal life, right? Or universal life with secondary death benefit guarantees, no lapse, right? Which ironically have been lapsing, but for other reasons. But those products were built with guarantees that are oriented toward the consumer. oriented toward the client. But all products have guarantees. I've had some say, well, why then, I compared the guarantees of a whole life policy to a GUL, and the GUL blew it away. The guarantees in a whole life policy are not actually oriented toward the consumer. They are, insurance companies are financial institutions like banks. They have to hold reserves. So the guarantees in non-GUL products are all about the same. They're all based on the same maximum mortality charges, the same maximum expenses, and the same minimum interest. So comparing guarantees in anything but a GUL or no lapse or a UL with secondary definitive guarantees type product is, I don't think, very informative because it's really not a number that's designed for the client. It's a number that's designed for the regulators. Did that make sense?
Piggyback off what Ram and you just said. A lot of these insurance companies are merging now. A lot of them have new products now. How does the reserve requirements for a new firm or a new policy translate into cost, and how does your research cover that as well?
So I am not aware that the reserve requirements, change because of a merger. Now there may be a company that's failing, whose reserve requirements have fallen, and the acquiring company has to get them back up. But I'm not aware of any requirement or any exception to reserve requirements as a result of mergers and acquisitions. They've got to get they've got to get those reserves back.
Okay, so let's say a newer company versus an older company, their reserve requirement is going to be higher because they don't have that claims paying history.
So a new company versus an old company could have different reserve requirements. They might have higher reserves because they've been in business long, but I think the requirements would be the same, right? Which brings up an interesting point, though. So reserves are one of the things that's factored into financial strength and claims paying ability. And some practitioners and clients say, I really don't care about the claims paying ability of the company because it's my understanding no insurance company, no death benefit has ever not been paid, right? So why do I want to pay a premium? Why do I want to pay extra for high financial strength? Just like why would I accept a lower yield on a bond for higher rates, right? When my kids are going to get the money anyway, right? I personally think that the reserves and the financial strength and claims paying ability of the company is maybe not better used, but another use. It's an early warning sign for cost increases because, as you pointed out, you got a company that's in trouble. Their reserves may be under their requirements. They get acquired. The new company's got to get the reserves back up. How do you get the reserves back up? If you're an insurance company, what do you do to get the reserves back up? Raise the cost or decrease the interest, right? And that's happened a number of times. Yes?
Yeah, Barry, do we have the ability, or do you have the ability to do this type of analysis for like long-term care and things, that type of insurance?
Really good question. It's a really good question because I can't answer it, or I don't have an answer, or I don't have a good answer. So we've built these benchmarks. Any benchmark is built on commonality, right? You can't build a benchmark for things that are totally disparate. Benchmarks are built on commonality. Because of the wide disparity in benefit provisions, elimination periods, the way they're paid, the way they're paid for, I've not found sufficient commonality to build a benchmark, so we do not yet have the ability to benchmark long-term care insurance or long-term care riders. What I would do is you run a Verillic report on a policy that has a rider, but run it with and without the rider, which will quantify the cost of the rider, and then go look at a long-term care policy, a standalone long-term care policy, and compare the cost and benefits of those two things. And then it's a little more work, but it gives you legitimate decision support at least. Make sense?
Thank you. Yep, thank you.
Okay, and the step 6 is monitoring, which I joke, only half joke, that The life insurance industry operating system doesn't even have a monitoring module, but the monitoring module is periodically do 1 through 5, again, just like you do for every other asset. So in my experience, life insurance is being promoted more today as its own asset class, inversely correlated asset class, even though it's among the worst performing assets. I mean, why you would ever promote an asset that's been among the worst performing assets for 3 decades as its own asset class, I don't know. But maybe they're running out of other things to sell. So if it's being promoted as an asset, and if the life insurance industry operating system, as I think I've shown, is ill-equipped to actually treat it like an asset, the people in this room can probably help out with that. And in so doing, avoid those things that the life insurance industry does that are misleading, fundamentally inappropriate, unreliable, keeps you out of harm's way, leads to better decisions for your clients. Not that prudent investor principles guarantee results, but over 200 years of evolution, of case law, of debate, they substantially increase the probability of clients being satisfied. And the best practices, I hope I've shown, gives you a framework for such a conversation with clients or prospects, for maybe addressing a new asset that you haven't addressed behalf, maybe bringing new clients in the door, and applying what you already know to life insurance. I mentioned that I've got at the table a number of things. I have a few copies of the best practices, but it's all online. I can email you links to it or email you PDFs if you give me your business card or send me an email, which my contact information is coming up. The Cochran case I mentioned, it's one of the pieces I'm most proud of. It really is a comparison of practices and outcomes from the way the life insurance industry works and the way your industry works, and how a much better result could have been had somebody in this room been advising that client instead of the life insurance agent that was selling the trustee. The Goldman case article was from Investment News. I can also send you a link to everything that I've written for Investment News. I've got at the table 3 questions to ask about every life insurance policy review. It simply talks, it puts into a marketing piece. You can co-brand it if you're a subscriber. We'll co-brand it for you if you're a subscriber. It simply talks about in one page the things that we've talked about here today, the things to look for. And the blessing of a patent is also a curse. The blessing of a patent is the United States government gives me a monopoly for 20 years. The curse of a patent is nobody in this room, unless you've used it, nobody in this room knows how to use it because it didn't exist. So we're confident enough in our work product that anybody in the room who wants a complimentary report free of charge, we'll give you the experience on our nickel. Free test drive, just send, and by the way, if you have a matter on your desk, an existing client who has a policy or a client who's considering a policy, redact the client's name. What some insurance company is charging them has nothing to do with their identity. Redact confidential client information. And you can either fax, email, or upload the illustration, and we'll get you a complimentary report. Any more questions? Hopefully I have answers. Yes, sir.
I just wonder if this is common knowledge, but I've been 52 years in the industry. I've been through 3 mergers and acquisitions, and every one of them have been detrimental to the clients of the acquired company. Are you seeing that as a general rule altogether?
Yeah, it maybe not universally, but it certainly speaks to this gentleman's question over here.
Yeah.
That, why do companies get acquired? Sometimes it's because, my dad was a Fidelity Mutual agent and then a New England Mutual agent, both of which got acquired. And so I've got some long but vicarious experience back then, and then to this day, there are absolutely carriers who have acquired companies and they're jacking up costs because the companies got in trouble because the blocks weren't profitable.
Yeah. What do we as agents have exposure then, lawsuit exposure, from the clients of the acquired company?
Say that one again.
do we as agents have lawsuit exposure from the clients of the acquired company when it's been detrimental to the clients?
So, to date, there's not, well, so the Goldman case is the first indication that that might be coming. If you are an agent of the company, there's some case law that says that you do not have the same duties to the client that you would if you were an advisor. Right? People in this room would the plaintiff's attorney would probably try to paint you as an advisor. Right? You're not selling. Pick a company. Pick a company. Hartford. You're not selling Hartford's policies. You're talking to the client about their IRA and their investments, and you're advising them about what they should do, what's in their best interest. If a plaintiff attorney were successful in portraying you that way, and the company's products who you placed increased their prices, and all you had in your file was a couple of illustration comparisons, I do think there's liability there. If, however, you said, well, wait a minute, we don't have to be right as fiduciaries, or even if we just have a fiduciary orientation. We don't have to be right. We just have to follow a prudent process. And we followed that process. We measured costs. The costs were competitive when the policy was acquired. We periodically monitored those costs. The company got in trouble because of other things totally unrelated to my client's situation. And so we did what was prudent, and we can prove it. I don't think you have liability if you do that.
Hey, Barry, I have a question, actually a statement and a question. Are you implying pretty much that the security side of monitoring and oversight of that wonderful industry should be applied to the life insurance industry?
I mean,
that's actually
inherent.
I'm being for, go ahead.
Inherent in the Prudent Investor Act and Prudent Investor Principles. Monitoring is inherent in Prudent Investor Principles, and it's actually in the preamble of the Prudent Investor Act.
That's assuming that the security side has done a good job, which in my opinion they have not. What we need is more ethics, integrity in this country, and that starts with implementing the laws that are on the books in this country and draining the swamp. We need to take the people that are committing the crimes, like most of the politicians, government officials, et cetera, and put them in jail for the crimes that they do. And when we address that issue, integrity and honesty will follow down the pipeline to where we could have the same thing apply on the insurance side, which I agree. There are unethical people on both sides, and I like your system and everything, but to assume that the security side is doing a great job of oversight and all this protection.
I did not mean to imply that.
Okay. All right.
I did not mean to. All I meant to say is that prudent investor practices, whether they apply to securities or life insurance that happens to be a security like variable life, that monitoring is one of those things that you should do. I have, to this point in my life, bitten off all I can chew in trying to change the itty-bitty $3 trillion business that is the life insurance industry. I'll tackle Washington in my next life.
Now, that's the next question. Trump being bad for liquidity, I didn't understand that remark.
Trump being
You
bad.
said about the life insurance, you should pick a plan that has less surrender charges versus its a comparison to the other company because we have a current president.
Oh, okay. So Trump prides himself on being unpredictable. So if our commander-in-chief is unpredictable, we live in more uncertain times, maybe more changing and volatile times than maybe under past administrations. So if we don't know what's going to happen tomorrow, optionality is maybe more important than not. And so having a policy that gives us optionality was my joke. However, I also said that a policy with an exit or with an exit without cost is better than a policy that has high restrictions on getting out when all things are equal, but all things are never equal. So if you have a policy that has high restrictions on it, for instance, guaranteed universal life policies typically have very high restrictions on them, but if you're getting something for it, like guarantees and maybe a price break, if you give up liquidity or give up access to your account values in order to get a lower price, that's a trade-off that's worth at least examining, right? That's what I intend to say. Yes, Ed.
Okay, thanks, Barry. Real quickly, it's being promoted, life insurance, use it in retirement because the cash values won't affect your Medicare premium or Social Security taxes depending where your income is. Do you have an opinion on which policy you think is the best out of all of them, and using a scenario like that? The whole life, the universal, the VUL? I mean, I have my own opinions. I just want to hear yours.
So I would answer it not in product type, but I would answer it with the product that offers the lowest costs, the best investment performance, from a carrier with stable pricing representations. And there was one other one I thought of when you were talking, and now I forgot it. And a product that allows cash values to be allocated in accordance with the client's investor profile. That would be the way I would think about looking for a product for a supplemental retirement type vehicle. I really don't care whether the specification pages of a policy say whole life, universal life, or variable life. I want a policy that has low costs. I want a policy that allows cash values to be allocated in accordance with the client's risk temperament. And I want one that has good performance. And I don't care what chassis it's on.
Okay. I think we're good.
Good.
All right. Thanks, Barry.
My pleasure.
As you know, I'm a big fan of using insurance the right way, even though I don't sell insurance, and it's going to be a big part of my PBS special, one act actually, coming up, because I think it's an untapped asset. And it's stable with all the uncertainties around tax law and things like that. You got to go for long-term stability, and I think that's where it is. All guaranteed products, you need stability. So thanks, Barry. Thanks, Dave. Where's Dave? Dave, for bringing it in. Thank you.